I'm Andy Kiersz. I'm the data editor for the economy team here at Business Insider. I'm here with my colleague, reporter Allie Kelly, and we're coming to you live from the Business Insider newsroom. We spent the day covering the Federal Reserve's December meeting. Now we want to dig into what we heard and talk about what that means for companies, for investors, for workers, and for job seekers. If you have a question, this is your chance to ask it. Drop it in the comments section wherever you're watching this video, and we'll try to answer it. Okay, Allie. So the Federal Reserve, as was widely expected, cut its benchmark interest rate by about a quarter percentage point today. So what's the Fed aiming to do with this interest rate cut?
Right. So the Fed kind of sets the standard for how much it costs to borrow money in the U.S. And that impacts consumers, that impacts businesses. It is a huge part of monetary policy in the United States. And by cutting interest rates in December, which is the last cut of the year, it's their third cut overall in 2025, the Fed is looking to potentially add some juice to a sluggish labor market, make it a little bit cheaper for these companies to hire people, to pay workers, juice consumer spending a little bit, and that comes at the risk of pushing inflation up a little bit. The Fed has a goal of 2% on inflation, which is we're a little bit above that right now, and so this is what the Fed calls their dual mandate. And they're really trying to balance the job market and inflation and put those in a place that are, factored into being, overall good news for consumers and for businesses. And with a pattern of cuts right now, I think that it's highly possible that people will feel relief.
Mm-hmm. Yeah, and lower interest rates, great for workers, great for borrowers. So we'll see how that ends up going. One thing that jumped out at us today was that there was some dissent in the vote. Do you want to talk a little bit about that?
Yes. So we saw the most dissent at this meeting that we've seen since 2019. There were 3 Fed governors that dissented to this decision, and that doesn't necessarily mean that there's bad blood at the Fed. That's something that Powell just said in the press conference, is that there's, like I mentioned, 2 different risks. 2 different sides of the economic coin that the Fed is trying to balance, of the job market and inflation. And all of these people at the central bank are really making a decision of what matters more, what risks are they seeing, what do they feel is the most immediate urgent risk to deal with in the economy. And some of them would prefer a hold, some of them would prefer a higher cut versus the quarter-point cut we saw today.
Yeah, that was the wild part to me, was that we had not just people voting against it, but that we had people going in opposite directions for it. We had people who were more hawkish than the consensus, people who were more dovish than the consensus. You don't see that every day. As we said, we haven't seen 3 dissenters since 2019. So what do we think is going to be coming next year, or what do you think the Fed is expecting for next year?
Right, and one of the cool things that we saw today is the Fed releases their economic projections quarterly. And so we got a little bit of extra information with the meeting today, besides the press conference and that normal rate cut. Is we have some idea of what the Fed is thinking going into 2026. They're expecting some GDP growth, even more than they had projected in September. And that kind of growth, is good news on maybe for Americans that are feeling like the economy is really, really hard right now. It feels like, when you go to the grocery store, your receipt is so much higher than it used to be, or than you expected it to be. I know we've talked to job seekers that are really frustrated that they feel like they're putting hundreds, if not thousands, of applications into the void and really not having a lot of success. And so it was really interesting, at least to me, to hear the Fed have a really optimistic economic outlook for 2026. And that doesn't necessarily mean that everything will be fixed or everything's perfect. But I think we are expecting some growth, and something like unemployment is not something that Jerome Powell necessarily expects to get worse in the new year.
Yeah. What do we think is going to happen with interest rates in the next year?
Right. So the Fed outlined at least 1 interest rate cut in the new year, and that doesn't necessarily mean that it will happen. That it's a constantly evolving situation with where inflation is at, with where the job market is at, with where current events and trade policy and tariffs and everything are at. But we can expect probably, based on what the Fed has penciled in, at least one cut in 2026. And we'll see if there's more or maybe less.
Now, of course, as Powell always says, they follow the data, and yeah, so we'll see what happens in the new year. We put out a poll on LinkedIn asking our followers if they thought the Fed should continue cutting rates into 2026, and most respondents voted yes. But what was always fun is that the people who voted no were the most active in our comments section. Menno from the Netherlands, and I hope I'm pronouncing that right, had this to say: doing nothing and seeing how the market will stabilize would be the preference. What do we think about that idea?
I think doing nothing could, and this is something that we saw from some of the dissenting governors today, doing nothing could help stabilize prices. We still have inflation that is a little bit above the Fed's goal, and that's something that American consumers are feeling, in just like everyday buying of essentials and consumer prices. And we've got consumer spending is still pretty healthy right now, but I know from talking to my friends and family, I feel like when I go to the store all the time, it's just things are expensive. So there is the idea that if we were to hold rates steady, that could keep putting inflation in a place that is really reasonable and slow growing. But holding rates steady also could have really negative effects on the economy by continuing to make it expensive for companies to borrow money, for small businesses to borrow money, for Americans looking to get a mortgage. If those borrowing rates are high, there's less kind of dynamic movement in the economy and less money flowing through. And in the short term, or in the long term, that could really slow the economy down.
Perfectly segues into our next question that we got from a reader. We received a question from Allie on Instagram that I bet a lot of people are wondering: are mortgage rates going to see a substantial decrease in the near future?
I think it's possible. I think I would caution at the word substantial. I think we are seeing a pattern of cuts. We've had 3 cuts at the end of 2025, and that was after a pattern of holding throughout the rest of the year. And so it's likely that seeing multiple cuts in a row like this, people could start seeing that show up in their interest rates as they're looking to buy homes. But I don't think, unless we continue to see several more cuts in 2026, that will have a substantial impact.
For sure. And how else do we think that the today's Fed move could impact people?
Right. So there's a lot of different ways. I think that the Fed can feel like it's some kind of looming thing over here that doesn't apply to regular people, but it does really trickle down in the economy and impacting daily life. I think that people are going to see, with another rate cut, lower rates on their credit cards. It's a little bit easier to pay back that loan and pay back that money. I think that we mentioned mortgages, auto loans. It's going to be a little bit easier to buy a car, or lease a car. But on the other hand, something like savers trying to put money into their high yield savings accounts, having lower interest rates is going to mean that they're getting kind of less return on that. So it is a little bit of a double-sided coin, but overall, lower rates are something that consumers tend to like.
Awesome. And yeah, I agree. Yeah, there is that. What's good for borrowers is not always good for lenders and for savers. So yeah, there are always the trade-offs. How do we think this might affect the job market going into 2026?
Yeah, I think it will take a little bit of time to tell. These things aren't necessarily immediate. We'll see maybe a little bit more of an immediate market reaction, which we'll talk to Joe about. But from a job market standpoint, having this pattern of lower rates, and I know I said this, but kind of what's really important here is not just like a single cut. It's seeing how much is the Fed lowering rates or hiking rates or keeping rates steady over a series of several months and years. And so because we have seen this pattern in the last couple of months, and we might see another in the new year, it is at a point that it really could start impacting the job market, and that would be good news for people looking for jobs because companies might hire more. I know we've talked about at BI a little bit about the Great Freeze and the idea that the job market is really frozen right now, where there's all these people looking for work, and companies really aren't hiring, and it's just kind of this stalemate where over the summer we had more people looking for jobs than there were job vacancies in the first place. And so it's this really challenging point for the economy. It's really frustrating for job seekers. And hopefully, if it's a little bit cheaper for companies to borrow money, we could see it get a little bit easier to get a job. But time will tell.
Yep, that is their goal. All right, great. Now I want to bring in Business Insider's expert voice on markets and investing, Executive Editor Joe Ciolli. If you have a question for Joe, Allie, or myself, drop it in the comments section and we'll try to get to it. Joe, thanks for being here. How are the markets reacting to the Fed's announcement today?
Yeah, it's great news for the stocks right now. We closed just below a record high, a matter of points. The S&P was up around 1%. Investors got the rate cut that they were expecting, and then they got the added bonus of a boosted U.S. economic growth forecast. So all is well in stocks land. In terms of the bond market, we saw a decline in bond yields. This actually reversed a big increase in the 2 weeks leading up to the decision. That was fueled likely by inflation fears. We have a new Fed chair that's going to be announced next year that's expected to cut rates. So that is viewed as inflationary. And then it's also probably being driven by the fact that the market doesn't really believe the Fed that there's only going to be one rate cut next year. It's pricing in two. It was pricing in two before the meeting. Nothing that the Fed said shook the market from its slightly more dovish view. So that's also likely informing the decline in bond yields. And I think more than anything, both the stock move and the bond move shows that investors are willing to look past inflation and worries of inflation right now, at least for today. So I would say a pretty nice win across the board for risk assets.
Awesome. Shame we didn't get the record high in stocks. That's always fun when we get to put that headline
I know.
up. But alas.
I was rooting for it.
Yeah, we always are. What do you think the implications are for the broader economy?
Well, the headline here really was that the Fed's economic growth target for next year got bumped higher, 2.3%, up half a percentage point. So that's a clear positive. And then in terms of the guidance around rate cuts, it's a win-win. And that's, I think, what you're seeing manifest in the near stock high today. If the economy is strong enough that it doesn't need rate cuts, that's good. That's a positive in and of itself. If it does need some help and it does need stimulus and the Fed is willing to cut rates, which it has shown it's willing to do, then that's good too. So we have a win-win there. And then as for Wall Street, from their perspective, they're still pretty divided over how many rate cuts we're going to get. You have everything from the likes of Citi calling for 2 rate cuts in the first quarter, which would be, of course, double the Fed's target already right there in the first quarter. And then you have Goldman Sachs, who thinks there's going to be 1. And I think that the consistent theme across all of them is just that the economy is going to be resilient, and that's going to continue to drive stock gains in the first half of the year, especially.
Awesome. What else are you keeping an eye on in the next weeks and months coming up?
I think I'm just starving for economic data. There's not been a lot. We had the government shutdown, the record length there. We didn't get a couple of jobs reports. Inflation data has been delayed, if we've gotten it at all. And so I think we just need more information. And the Fed admitted coming into this meeting that it didn't have a complete picture. It was sort of on the back foot, playing a little safe, given the lack of information. So we're going to be getting a deluge of data. We're going to get all our normal reports. We might get some delayed reports. And what we could see is some really strong or really weak data, like really altering the calculus of future rate cuts pretty significantly. And I think investors are receptive to that. And then in terms of what economic data specifically is most important at this moment, it's got to be the labor market. The Fed it said it even today in its comments. It's got a really laser focus on the labor market. It's been the weak point, and it's been the rationale for why we're cutting rates. So if there's a further deterioration, that would make the Fed probably more likely to cut rates again. If it's looking good, like it's going to fix itself on its own with current conditions, then maybe not going to get as many rate cuts. So labor market is really one of the only games in town in terms of economic data. Not the only game. Inflation's also there, but it's number one, and I'll be watching that.
Yep. I'm also very much looking forward to our Rare Jobs Tuesday coming up next week with the delayed November jobs report. Awesome. Okay, we're going to leave it there for today. Thanks to everyone for tuning in. If you want to hear more from Joe, you can sign up for his newsletter, First Trade, and you can read more from Allie and me right here on Business Insider.